The last part of this chapter, equity valuation, is the free cash flow valuation approach. We will not do this one very detailed, but this is very important part because in practice, many analysts and many companies use this approach to evaluate the firm. So first of all, what is the free cash flow? The free cash flow is the cash flow that generates from using asset every year. Each year, you can calculate the free cash flow using the accounting statement. And this cash flow is really the generated cash flow from using company's asset. So company's free cash flow is the amount of the cash flow that generate by using all company's assets, which means that the present value of this free cash flow will be the firm value. So first of all, the free cash flow can be easily calculated by the one that we learned actually in financial management class 331 intro class or any intro finance class to calculate cash flow from assets. If you remember how to calculate the cash flow from asset or how to generate, like how to estimate the cash flow from the project, and that's basically the same thing. So the free cash flow has a three part. The first part is operation part. That's the first part. So EBIT, earnings before interest and taxes, times 1 minus tax rate plus the depreciation, because the depreciation is not cash item. And then second part is capital expenditure, which is the net capital spending. So the amount of money that you use to buy or sell the fixed asset. So if you sell more asset, or buy more asset, which means you expense more, then your cash flow declines. And finally, about net working capital, increases in net working capital. And net working capital equals to current asset minus current liability. So if the current asset is greater than current liability, then your net working capital increases, which means that you buy more current assets, so your cash flow decline because you use that cash to buy current assets. So this is called the free cash flow for firm. This is a free cash flow for all firms, Now this free cash flow goes to two parties. One is the debt holder, the other is equity holder. So this is about whole company. Now some free cash flow only focus on the equity holders. So this is called the free cash flow to equity holders. Now, free cash flow to equity holders may be calculated by starting from the free cash flow for the firm minus now, these are the free cash flow to debt holders. Debt holder receive two free cash flow. One is interest expense, the other is the new debt. So if interest expense increases, then the debt holder receive the free cash flow, right? So if you have a parenthesis, then it should be negative, right? So interest expense times 1 plus TC, the tax rate is one factor of the free cash flow to debt holders. And the other factor, new debt, if new debt is raised, then the company borrow money from the debt holder, so free cash flow to debt holder declines, so that will be negative. If you just erase the parentheses, then it changes to positive, right? So this is the formula for free cash to equity holders. So how to use this? So estimating terminal value using constant growth rate, which means that usually what you can do is that you estimate free cash flow for, first of all, for the firm first. And then you keep having some years, say year 2, say year 4 maybe. You estimate then, and then you finally get some constant growth rate, some terminal year. So in this case, maybe 4th year, maybe terminal, 10th year, maybe terminal. It depends on you. In many cases, they usually estimate up to 10, then they make 10th year terminal year, and then they calculate the growth rate, the constant growth rate. If they have constant growth rate, then they actually can calculate the price as of t. So firm value as of t equals to free cash flow for the firm t plus 1. So if t equals to 4, then next year's free cash flow, fifth cash flow, divided by weighted average cost of capital minus growth rate. That will be the terminal value. So you may have 4-year terminal value, 1, 2, say 3, 4. So free cash flow 1, 2, 3, 4, and then you have terminal value. Take the present values, then that would be the firm value for the company. Now you can also use equity So if you use the free cash flow to equity holder now, then we use the cost of equity instead of WACC because this is only for equity. Okay. So this approach is called the discounted cash flow approach. DCF approach. DCF approach. Now we'll see one spreadsheet and see how we use it. So this is a spreadsheet you will see. So this has 2014, 15, 16, 17, 18. I believe they think the 2018 is terminal year. This is all the input data. And you can calculate the free cash flow for the firm first. The profit here is 17,000. So you estimate these profits, 14, 15. So I think the 14 is the current year, and from 15 is basically the next year, right? So, and you have 13 estimate way to estimate the profits here, and you have interest, right? Because you have long-term debt amount here, so you can easily calculate the interest. Change in net working capital is simply working capital changes. So from next year to this year, this is change in net working capital. Depreciation is given. Okay. And then this is capital spending. Okay. If you have these numbers, then you can estimate this is the free cash flow for the firm next year. So the profit, which is EBIT, all right, that's the EBIT, times 1 minus TC. So 1 minus TC, which means this one, right? So tax. And then the next part is the change in net working capital. I mean, depreciation is actually at back, right? So this depreciation should be at back. And then capital spending should be subtracted. So you can actually use the formula, and this is free cash flow to the firm. Okay. So minus capital expenditure minus change in net working capital. Okay. So if you estimate this, now we have terminal value. Now we have discount rate for calculation. There is a terminal growth rate. We estimate this is 4%. So terminal value will be, now this is free cash flow, right? So free cash flow for the firm next year, which is 2019, divided by WACC minus growth rate. And this is free cash flow for the firm 18 times 1 plus growth rate divided by WACC minus 3. And if you plug number into this formula, this will be terminal value, which means that if you sell this company in 2018, then you will receive this amount. That's what it means. So it means that you actually have to get the present value. So the value of the firm in 2014 equals to 40 divided by 1 plus WACC. So WACC is what? WACC is, I believe there's a WACC. Oh, WACC keeps changing actually. So WACC plus 17,418. Second one, 1 plus, say, WACC square 19,875. 1 plus WACC to the Q plus 23,333. That's the terminal years free cash flow of the firm plus 606,782. That's the terminal value. So when the company is sold, then you receive this much. 1 plus WACC to the fourth. Then that's the value of the firm 2014. Okay. So the spreadsheet calculate the WACCs and calculate the present value factor, and this is the present values, and you find intrinsic values like this. Okay. Now the problem is this includes the debt value too. So this intrinsic value includes the debt value. So you only want to get the equity value, which should subtract by the current long-term debt. So what you can do is, if you get the firm value, right, minus long-term debt 14, so 14, that will be the equity value. So value of equity 14. Okay. And we are interested in the value of equity, not the value of the firm itself, right? Because we only pay for equity value. So you subtract the equity, the debt, long-term debt, then you can find the per share price divided by number of shares outstanding. You can find this one here, 10,000 shares, right? So eventually, the price is $25.18. That's how to evaluate it. Now, if you use free cash flow to equity, then what you have to do is, so you start from this, then you basically have to subtract by the free cash flow debt holders from the previous formula. That's what it is. Then you have to get the present value factors by using this equity K, right? So the thing that you need to do is the same, but you need to use the cost of equity and calculate the present values like this. So present value to equity holder is this one. Directly calculate the intrinsic value, and this value can be is actually calculated by the free cash flow to equity holder, which means that this itself is equity value. So you don't need to subtract by the long-term debt, and this equity value divided by number of shares outstanding, and 2673. So it's pretty close. Either way is fine. Many people use actually first way. But either way is fine. Either way is fine. Either way is fine. You can use the free cash flow for the firm or free cash flow to equity holders, get intrinsic values. And if you use the free cash flow for the firm, then you have to subtract by the long-term debt amount. Eventually, you can get the equity values divided by number of shares outstanding. Then you can get the answer, the per share price. I mean, this method is again DCF, which is widely used method, especially if the firm is privately listed and you are going to acquire this firm, then you need to do this because you don't have any market values, right? If the company wants to acquire some other target firms, then you need to actually evaluate the firm value of the targets. That basically need to be done this type of approach, DCF approach. This is quite widely used in practice. So if you are more interested in this approach, then you probably more dig more into the field, like reading the textbook, or there's some project, or you can ask me a question. We can solve the project together, maybe explain more detail in person. That may be more useful. You can actually ask me through Zoom or anything else, you know. Okay, so this free cash flow approach, basically, if you compare with these other approaches, you know, these kinds of, I mean, there's no rule of thumb, you know, there's nothing, you know, better than the other, basically, because there are pros and cons for everything. Now, the DCF approach is great because it's very thoroughly done, and you use a lot of information. What people usually do is, analysts usually do is, I mean, we use pretty simple, you know, the models, but if you have the financial statements for years, we usually use this historical data to estimate future cash flows, actually pro forma financial statements, which means future financial statement estimated. When you estimate the future financial statement, what you can do is you can use historical data, but you also have to restate the financial statement, because the financial statement does not reflect everything, right? So to thoroughly do the fundamental research, then you generate the financial statement for 10 years usually, and then you finally have some kinds of reasonable growth rate for the terminal value, calculate terminal value after 10 years, take the present values, you know, up to 10. What happens is you can get the present value for the firm. Great scientific way, but the problem is you have to forecast many variables. The DCF approach can be manipulated very easily, because if you change the number a little bit, number will be completely different. That's the biggest cons, you know. So DCF estimates are always somewhat imprecise, because this is estimation. G is very heavily related to the values, you know. So growth rate, very important. So investor employed hierarchy of the valuation in many ways, depending on the situation. Now we have two more slides. You know, the aggregate stock market. We usually also forecast the aggregate stock market, which means that what about the market level forecast? Earnings multiplier also applied at aggregate level too. You can get the S&P 500 earnings multiplier and comparing with the PEG ratio close to 1 or not, that you can say that, oh, this aggregate market itself is underpricing, overpricing, using the same logic we had before. Some analysts also use aggregate dividend discount models. So the forecasting aggregate stock market, example 30.7, just to read down. In late 2014, the S&P 500 was at 22,040. The forecast for 12-month forward earnings per share for the S&P 500 portfolio is about $134. So that's the kind of estimated for earnings per shares. The 10-year Treasury bond yield, which is usually used as a risk-free rate, at this time was about 2.3%, but yield curve is relatively stiff. So a plausible forecast for its value next year will be higher, perhaps 2.8%, because yield curve is kind of little stiff. As first approach, we might posit that the spread between the earnings yield and the treasury yield, which was around 3.2% in 2014, will remain at the same level by the end of the year, just assumptions that. Given the same treasury yield, this would imply that the earnings yield for the S&P 500 of 6%, or P/E ratio of 1/0.06, right? So 16.67. The forecasted level of the S&P index would then be 16.67 times 134 times, which is the also forecast for the earnings ratio, 2,233. So 1 year later, we expect that there will be the capital gain about 193 from 2040, so about 9.5% earnings. So that's kind of the, you make assumption, you use the P multiples and to get the estimated next year the S&P 500 index. Of course, there is uncertainty regarding all three inputs into the analysis. Earnings may be different, right? Treasury yield may be different, and then spread yield and earnings yield may be different. So what we have to do, usually do the sensitivity scenario analysis to examine these changes first of all. And also, we can also do the simulations, So there's a number of ways to estimate this. Again, this is estimation. Everything is forecasting. So the stock market forecast is not very easy because we have to estimate many numbers. And the sensitivity of each number may be pretty critical. That's why we actually have to have sensitivity analysis, scenario analysis, even simulation analysis to estimate more accurately. Again, uncertain factor is very hard to control for. That's one of the biggest reasons in equity valuation. So that's my last word in this chapter. So thank you for watching the chapter 13 slide.